ZIM, a global shipping company, is well positioned to take advantage of growth opportunities in the container shipping industry. With a focus on operational efficiency and customer acquisition, ZIM is working to increase container volumes and expand into new markets. Additionally, the company has taken steps to reduce its environmental impact by renting ships and using LNG as fuel. With a strong financial performance and a competitive advantage in the industry, ZIM is a promising investment option for investors looking for growth potential in the shipping sector. Following the downturn of 2020, ZIM recovered well in 2021 and 2022. The cash available with the company reached $3.6 billion and $3.2 billion in 2021 and 2022 respectively. Additionally, ZIM's capital adequacy level has shown a remarkable improvement from $4.6 billion at the end of 2021 to $5.9 billion in 2022. Debt also increasing from $1.8 billion at the end of 2020 to $4.3 billion in 2022. After the drop of net debt to $365 million in 2021, the company's net debt increased and reached $1 billion by the end of 2022. However, ZIM's net debt level remains lower than its cash generation and equity level, providing opportunities to benefit its shareholders and manage upcoming risks. Overall, ZIM's capital structure is in a very healthy position. Some potential areas of focus for ZIM's growth and revenue targets over the next 2 to 3 years may include expanding its customer base. ZIM may grow its business by acquiring new customers in existing markets, as well as expanding into new geographic regions and industries as the total revenue of ZIM Integrated has increased by 17% from $10.7 billion in 2021 to $12.5 billion in 2022. Increasing container volumes. ZIM's revenue is closely tied to the volume of containers it transports. To increase revenue, the company may focus on increasing container volumes through increased market share, new customer acquisitions, and improved operational efficiency as the world economy is expected to increase by 1.7% in 2023. Improving profitability. ZIM may also look to improve its profitability by optimizing its pricing strategies, reducing costs, and streamlining its operations. As we analyzed the profitability ratios of ZIM Integrated to figure out how well the company could make a profit and use its assets to make money for its investors, we have analyzed the productivity proportions, which gives helpful bits of knowledge about the organization. To provide the insightful information about the financial health of the company, we compare the profitability ratios to previous years. The gross profit margin was 7.64% in 2018, which was increased to 14.82% in 2019 and has been rapidly increasing from 28.98% to 63.59% in 2020 and 2021 respectively. ZIM Integrated had significantly better margin ratios in 2021 and 2022 compared to 2020 and previous years. Specifically, the company's total revenue increased by 17% from $10.7 billion in 2021 to $12.5 billion in 2022. The company's profit and EBITDA levels improved and led to slightly lower margin ratios as compared with 2021. Drewry's World Container Index, commonly abbreviated as WCI, is down 79% year-on-year and 84% lower than September 2021. For the year to date, the average composite index per 40-foot container is $1,923, which is 36% lower than the 10-year average. Container freight rates are affected by global economic problems, high inflation, and high interest rates, which brings down the purchasing power of consumers. In the United States and European countries, inflation is the main cause of falling demand for goods and an increasing inventory-to-sales ratio in 2023 for various companies. But there is hope for the future as annual inflation rate in the United States fell to 5% in March 2023, the lowest since September 2021, and import prices in the United States also fell in February 2023, signaling a possible fall in inflation in 2024. On the positive side, global container trade volumes could increase in 2023 due to higher demand in the second half of the year. According to the World Trade Organization, the world merchandise trade in goods will grow by 1.7% in 2023 and by 3.2% in 2024. Dineo Shipping estimates that global container trade will slightly grow from 213 million TEU in 2022 to 218 million TEU in 2023. It is worth noting that DAC has a charter backlog of $126 million with ZIM through 2028. However, Navio's Maritime Partners forecasts a decrease of 1.6% in world seaborne container trade in 2023, before increasing by 3.3% in 2024. It is worth noting that NNM has $865 million contracted revenue with ZIM. ZIM's main competitors in the shipping industry include Maersk Line, MSC, CMA CGM, and Hapag-Lloyd. These companies compete with ZIM for business by offering similar services, but may have different elements such as pricing, transit times, and reliability. In terms of investment strategies, ZIM stands out due to its unique advantages, such as its strategy of renting ships instead of owning them outright. This approach helps to mitigate risk and provides greater flexibility, allowing ZIM to quickly adjust its fleet size in response to changes in demand. Moreover, ZIM's recent decision to use liquefied natural gas as a fuel source demonstrates its commitment to sustainability and reducing its environmental impact, which could give it a competitive edge in the market. The tight monetary policies of central banks in the United States and Europe have led to a decrease in high inflation rates. However, there is a risk of instability in the financial system due to high interest rates and uncontrolled tight monetary policies, which could negatively impact consumer purchasing power. It is important to monitor the side effects of high interest rates closely. NMM's Container Industry Overview estimates net fleet growth at 6.7% in 2023 and 5.5% in 2024. Additionally, port congestion may be fully resolved by the end of 2023. However, if the supply of container ships exceeds demand, ZIM's market outlook may become unfavorable. To conclude, ZIM is a company that may offer profitable returns to investors in the future. Conservative investors may want to wait for a market dip to initiate a position in the stock, aiming for an entry point around $16. Investors with a longer-term outlook and higher risk tolerance may choose to use a dollar-cost averaging strategy, spreading their investment over a period of time to mitigate the impact of market volatility. Additionally, selling put options with a strike price of $16 and a longer expiration date, such as 6 months or more, could be a viable strategy to benefit from the premium and possible assignment in the event of a market downturn. Thanks for watching.